So now let's examine some of the profitability ratios. Here we are comparing the return available on investments. And the first ratio that we'll consider is profit margin on sales. And the formula is net income available to common stockholders divided by sales. So this ratio tells us as to what are the returns on sales. And I got here the figures. $113.5, that is the net income available to common stockholders, and we divide this by $3,000, that is the sales, and the answer is 3.8%. So what it means is that the sales are generating returns at the rate of 3.8%. And now we compare returns with total assets. So as you will appreciate that total assets of a company means the total investment in the business, and how much that investment is generating in terms of net income. That is what we pick up from this ratio. And as you can see, the answer is 5.7%. So what it means is that the assets are giving a return of 5.7%. And now we compare the net income with common equity. So the answer is 12.7%. So that is the return on the money that is invested by stockholders in the company. So the stockholders are earning 12.7% on their investment. Now we introduce the stock market in our ratio calculation, and we compare the market price of stock with the earnings generated by the company. So the formula is that we have the market price of a stock divided by earning ratio, and the earning ratio is calculated by computing the earning per share. It is also known as EPS. So this ratio is also referred as PE ratio, and PE ratio is very important ratio for investors who invest money in the stocks of the company. And as you can see that the price of the stock is $23 and divided by the earning per share, which is $2.27, and the answer is 10.1 times. So what it means is that the investors are willing to pay 10.1 times to earn $1 earning in the company. This ratio shows the investors' confidence and trust in the management of a company. So this ratio compares the market price of a stock with the book value of the stock. And how we calculate the book value of the stock, the formula is there. It's common equity divided by number of shares outstanding. So if the common equity is $896, and if the share outstanding are 50, so the ratio is $17.92, and that is the book value of the stock. and we compare this book value of the stock with the market price, and the formula is there. We divide market price per share by book value per share. So if the market price is $23 and the book value is $17.92, the answer is 1.3 times. So that means that the market price is 1.3 times of the book value of the stock. Another very important ratio is dividend payout ratio. And in this ratio, we consider as to how well the dividend is covered by earnings of the company. The formula is we pick up the dividend per share figure and we divide that by earning per share. There's an example here that if the dividend paid per share is $4 and the earning per share are $16, so you can see that the dividend payment is covered by the earning per share 25%. So that means these dividends are adequately covered by earnings of the company. And now we consider the dividend yield ratio. This ratio considers the return that is available to the investors in the stock market. So the formula is that we got the dividend per share and we got the market price. We divide the dividend per share by the market price to find out as to what is the dividend yield to the investor in the stock market. So in this example, we got market price $20 and we got dividend per share $2. So we divide $2 by $20 to get the answer 10%. What it means is that the investors in the stock market can expect 10% return on their investment in the stock of the company. So now we are down to market value added or MVA ratio, and in this ratio we compare the equity that was supplied by investors with the market value of the equity. So the formula is we pick up the market value of equity and we deduct the equity supplied. Now let's take the example of Coca-Cola company. In 1995, the market value of the stock was $69 billion and the equity that was supplied by investors was $8 billion. Likewise, the General Motors market value stood at $69 billion and the equity supplied was $87 billion. So we got the two opposite cases. Coca-Cola that performed very well and GM Motor that did not perform so well. So this is the economic value added or EVA ratio, and here we consider the operating profits after tax with the cost of all capital. So when we talk of cost of capital, we are considering the dividend that is paid out to stockholders and the interest that is paid out to bondholders. So let's see an example in the next slide. The formula is here. We pick up the sales revenue, we deduct the operating costs and taxes, and then we have the total capital supplied times the cost of capital. We deduct the cost of capital from the uh, profits to find out as to the performance of the company has generated how much returns on top of the cost of capital. So this is an example that if the sales are $100 million, the operating cost 80 million, the taxes 10 million, so the operating profit is 10 million, and the cost of equity uh, is there at 10%. And we continue this example. So as you can see that it's the $10 minus $50 times 10% gives you $5, and we deduct $5 from $10 to give us $5 million. So that is the economic value added of the firm. Well, I hope you got hang of what the ratios are all about. I've given you some examples and also explained you the various types of ratios. And remember that these ratios are extremely useful in assessing the performance of the key personnel in the company, and also they are used by uh, external uh, parties like banks, stockholders, creditors of the company, vendors, banks. So these ratios are extremely important. And remember that these ratios relate to non-financial firms. In the next presentation, I will give you the ratios for financial institutions. So until then, see you around. Bye for now.